everybody, Tara with Dwell Mortgage here. Today we are going to talk about divorce and mortgages. Unfortunately, it's not the most fun topic to discuss, but it's very real. I'm sure everybody knows that almost 50% of all couples end up in a divorce situation. So if you are in that position and you have a mortgage or you want to buy a house after your divorce is finalized, watch this video because a lot of people go through the divorce and don't understand how that's going to impact them down the road. A few things to keep in mind while you're going through a divorce. Say you're in a separation or you're still just kind of negotiating with your spouse about what the terms are going to look like. A few things happen where people get in trouble. It's a very emotional time. Sometimes other stuff of life gets a little too overwhelming and you forget to pay attention, but make sure you continue to pay all of your bills on time. A misconception with divorce is that the divorce decree will release you from the liability or the debt that you have with your spouse. That's not the case. So just keep everything paid on time. I've seen many divorce couples just come out of the divorce with their credit just ruined. Then that's a whole other situation. Number 2, have a divorce attorney write up your divorce decree. I know a lot of people try to do the paperwork themselves to save a little bit of money, save a little bit of time. And while I understand the desire to do that, a lot of people will put in very vague language when they do that, or it's not super clear on what the agreement is. And so when you go to supply your divorce decree with a lender or someone else after the fact it's all done, we don't really understand like the rules or the steps that we have to follow when we are working through it. It will save you a lot of heartburn in the long run, and me too. And third thing is follow what that divorce decree says. If it says you're going to do X, Y, and Z, make sure you do those things. Make sure you pay the bills that you're responsible for. If you're transferring title to property, you're moving assets around, do those things as soon as you can. Just, again, make this life a little bit cleaner. If you own a home and you're in a divorce, how do you get the equity out of that property? There's kind of 3 ways to do that. Typically what will happen, the divorce decree will award one of the spouses the property. That goes for all property, cars, assets, but we're going to talk about real estate here. So on the mortgage, typically one spouse will be awarded the home, and the divorce decree will say something along the lines of, the wife is awarded the home, she has X amount of time to pay the husband out 50% of his equity or of the equity of the home. So there's a couple ways to accomplish paying out their portion of equity. What I'm seeing now with current situations is people are going to their current lender, and trying to get a release of liability. So basically what that means is whoever's staying or whoever is awarded the home will get to keep the current loan with the current terms. And a lot more people are trying to do this who were able to take advantage of like the 2 and 3% rates during COVID. Nobody wants to lose those. So they'll try to go to the servicer of their mortgage and get a release of liability. That's totally up to the servicer and what rules they have in place. They don't have to do that, but it's worth a try if you have one of those really smoking rates. If you are awarded a release of liability, but you still have to pay out your ex in their equity, then you're probably going to do something like a HELOC or a HE loan to tap into the equity and pay them out that way. So a second mortgage where you keep the terms of the first mortgage all the same, do a second lien after that. Or you can do a full cash out refi. So it's a brand new loan. Whatever the current terms are, current appraised values are going to be what you get starting all over. You're going to have closing costs again, so keep that in mind when you're talking with your spouse about splitting things. If you're going to be doing a refi, you will have closing costs again. So make sure that that's accounted for in your numbers. Like most people will do just 50% of the net amount. The tricky part to that can be where rates have been a little bit higher in the past couple years, now we're going from a two income, or maybe we're going from a 2-income household to a single income household. Can that person qualify for that new house payment and pay out this X 50% of the equity and meet the qualifications of the loan, but still satisfy the divorce decree? So if you don't have enough income to do that, or that might cause a little bit of a hiccup in your plans to keep the home. The third option is, and probably the most common option I've seen just in the past couple of years, because rates have been higher, is you just sell the property, split the equity, and then everybody goes on and take the money and use it however they want. So a lot of people are doing that and then taking the proceeds from the sale of their house and putting that towards the new down payment. Anything that you do with a loan post-divorce is going to require the divorce decree to be finalized or a legal separation to be in place. Legal separations aren't as common in Utah, but if you're in another state where they do those also work. The reason for that is there's a ton of financial ramifications that are spelled out in the divorce decree. So like I mentioned earlier, property is divided, assets are divided, debts are divided. All of those things will impact what you can do on the next loan. So just something to keep in mind when you're, like I said, going through the divorce, when you're thinking about what you're going to do post-divorce, make sure that those things, you've taken those things into consideration, and feel free to reach out if you want to run numbers before all of that gets finalized so you kind of know what things are going to look like. So let's talk about the things that are in the divorce decree that will impact your qualifying. So debts. Typically, if a joint debt is awarded to one spouse or the other, we can exclude that from your debt to income ratio on the new loan. However, I want to refer back to what I said at the very beginning. Your credit can still be impacted if your ex does not pay the payments on that joint debt. So the divorce decree does not release you from the total responsibility on a credit level. Credit is a federally mandated, has federal laws. Divorces is done at a state level, so the federal stuff supersedes that. So just keep that in mind. Ideally, I always, to keep everything clean and simple, you really split everything up and remove everybody's names from everything. But if that can't happen, there's a joint debt, just make sure you are still monitoring that debt and your ex is getting that paid. But for the qualification purposes of the loan, we can exclude that from your debt to income ratio. All right, so alimony and child support. This is a big one. I've had this happen also several times over the years. People get their divorce finalized and then they call me and say they're going to move and they're awarded alimony or child support. The way we look at that, we are now relying on your incomes come from a third-party person who has to pay you in order for you to receive your income. It's not a company that has a payroll department and all of those kind of things. So we are going to want to see proof of receipt of your alimony and child support for at least 3 months on an FHA loan, 6 months for conventional loans. And like I said, that is because we are relying on someone else to write you a check, transfer you that money to pay you in order for you to have your income moving forward. So we want to see that they are paying that they're responsible, and you're getting that consistently. It also needs to continue for 3 years. The child support and alimony has to continue for 3 years. So say you have 3 kids you are awarded child support for, and their child support ends when they turn 18 or graduate high school. Say your kids are 12, 15, and 17, and you get $900 a month, and that 17-year-old is going to turn 18 and graduate high school in a year. We're not going to count their third of the child support because that's not going to be available to use income in a year. So it's, again, really important to reach out, make sure someone sees your divorce decree and is reading through all of those stipulations so you understand what will work for the mortgage and what won't. If we're talking about you are the one who's responsible to pay alimony or child support, and most of the time for most loans, we'll just deduct that out of your income. And the reason that helps is just kind of the way that the debt to income ratio calculations work. Instead of it being a liability and you having to have enough income to basically cover double, if we're going with the $900 a month example, we're going to deduct that $900 from your total income. It just helps keep that your debt to income ratio calculation in a more realistic range. Those are really kind of the main things that will come into play on your mortgage. So just to kind of recap, make sure to get it all in writing. Any lender or title company, whoever's involved with splitting up the assets after the divorce is done, is going to follow that divorce decree. So just to recap, like if you've watched any of my videos, get your plan in place sooner rather than later. Even if your divorce isn't finalized yet, start reaching out to professionals who are going to be working with you after your divorce. You want to start getting a plan in place for, how that's going to impact you for the next steps in your life. Get everything in writing, follow what the divorce decree says, and get your plan put together. If you have questions on how any of this works or want to get pre-approved, please shoot me a message.